Welcome back to the Deep Dive. You've sent us a stack of sources detailing one of the most controversial events to hit the digital asset space this year. And we're here to distill what it all really means.
It's a big one.
It is. We're talking about the fallout from Circle, the stablecoin behemoth, successfully acquiring the core development team and proprietary tech behind the Axelar Network.
And this deep dive is so necessary because this event isn't just news, it's a perfect case study. It shows a complete collision between traditional M&A strategy and the entire decentralized finance narrative.
Collision is the right word.
Circle's move was clinical, it was profitable for them, and it just brutally exposed a fundamental structural flaw in how most crypto projects are financed.
Okay, let's unpack that clinical move.
Yeah.
So Circle announces they've acquired Interop Labs.
Right.
And Interop Labs, for anyone who doesn't know, that was the initial development team for Axelar. We're talking the people and the intellectual property.
The brains and the blueprints.
Exactly. And their stated mission was pretty clear: to advance their own cross-chain infrastructure, things like ARC and CCTP, the cross-chain transfer protocol.
And you have to understand why they wanted that team and that IP. CCTP is absolutely essential for Circle's long-term strategy.
Yeah.
It's how they guarantee secure, standardized movement of their main asset, USDC, across all these different blockchains.
So it wasn't just a talent grab.
No, not at all. They were buying the specialized engineering talent and the patented processes, the secret sauce, really, to maintain a critical financial standard for their centralized stablecoin business.
So they bought the engine, this secure proprietary engine for cross-chain transfers. But here's where it gets. Well, this is the crux of the conflict, isn't it? They explicitly stated that the transaction excluded the Axelar Network project, the Axelar Foundation, and most importantly, the AXL token.
Wow. Yeah.
Got the talent and the tech they wanted and just openly left the decentralized project behind. A project whose entire valuation was built around that very talent.
They acquired the key people and the technical plans, but legally, they just walked away from the community, the token, and the whole governance structure. The press release even said the Axelar project would continue, quote, under community governance.
Which is just corporate speak, isn't it?
It's pure corporate speak.
Yeah.
It means the people who built all the value now work for us, but hey, you guys can keep the decentralized ledger.
And the market definitely understood that message. The AXL token just plummeted. A steep, rapid 15% drop almost immediately after the news broke.
And that wasn't just market volatility. That was a direct reaction to a fundamental collapse in perceived value, in trust.
Right. And that drop is the central point of our deep dive today.
Mm-hmm.
This whole thing forced the industry to finally confront this equity versus token conflict.
We have to ask the question now. What happens when the founders and the core devs cash out their equity in the dev company, but the token holders, the people who funded the project, who provided liquidity, are left completely empty-handed?
So our mission today is to cut through all the noise, all the anger. We're going to look at the arguments from both sides, the outraged token holders and the cold, hard capital structure realists, to really get at the truth of who gets paid when a company exits. Let's start with the outrage, because it was immediate and it was loud. We saw a lot of influential voices just immediately label this as unethical, a disguised rug pull even.
And you can see why. The opposition is coming mainly from early-stage VCs and token holders, and they feel, I think, justifiably exploited.
Justifiably based on what?
Based on the promises made when the project was starting out. I mean, these were the people who took on the maximum risk when Axelar was just an idea on a whiteboard. They provided the early cash, the feedback, the hype, all the things that helped the dev team build the value that they eventually sold to Circle.
Right. It feels fundamentally unfair. The team gets their exit, they realize the value of their equity, while everyone who bought and held the AXL token, which was the literal economic engine of the project's valuation, they got nothing. They were completely shut out of that exit.
And this is where the language starts to get really heated. Simon Dadek, the founder of Moonrock Capital, he did not hold back at all. He called it, and I'm quoting here, another acquisition, another RUG.
Wow.
He even labeled it practically a crime and then challenged future founders, saying either treat it like equity or get out of here. That just perfectly captures the sense of moral hazard, you know?
It's like selling the engine out of a car and then telling the passengers to just keep driving. And the accusations, they got even more specific. Mike Dudas, co-founder of The Block, he said the outcome was, quote, entirely on Circle's doing.
And he tied that blame to some pretty cynical rumors. Dudas cited whispers that Circle's VP of Corporate Development was just completely dismissive of the existing investors, supposedly saying something like, "I don't care about your investors."
Whether that's a direct quote or not. It shows the massive gap between corporate M&A thinking and, decentralized community expectations.
It also highlights the timing of it all. The founder of Lombard Finance pointed out that the team's equity had fully realized after 3 years. They'd done their time, their vesting period was over, and they were free to walk away with a big payoff.
While the token holders were left. What was the quote?
They were left clinging to a distant dream of future growth and decentralized governance.
That gap, that timing gap between the equity paying out and the token's future. That is the trap, isn't it?
It's the structural trap. The development team reached their finish line, a financial exit, at the exact same moment the token holders realized they had absolutely zero claim on that finish line.
And Zach Rhimes, a Chainlink community leader, he summed up that feeling of betrayal perfectly. He said that the promise of continued independent operation under community governance is really just the dev team abandoning users in pursuit of a better future. It undermines the whole system.
And that is a powerful, ethically compelling argument. It really is. But now we have to shift gears. We have to look at the opposing view, one that is rooted purely in the brutal reality of corporate finance and M&A law.
Okay, so we're trading the outraged glasses for the cold, hard glasses of due diligence.
Exactly.
So where does this reality check begin? What's the core of the legal and financial argument against the token holders?
It begins and ends with one concept,
Yeah.
capital structure. You look at people like Jeff Dorman, the CIO of Arca, who just stated it flatly. Tokens are inherently disadvantaged in the corporate capital structure, full stop.
Meaning, in the eyes of the law, Circle did nothing wrong.
Nothing. They just followed centuries of business precedent that dictates very clearly who gets paid first.
Okay, this is a crucial detail. For you listening, if you're not deep in traditional finance, can you break down how that capital structure actually works? Where does a token even sit in that hierarchy?
Okay, think of it like a triage system in an economic emergency. Everyone's in a line, they all want a piece of the company's value, but the priority is absolute, non-negotiable.
So who's at the front of the line?
Right at the very front, you have secured debt. These are bank loans backed by specific assets. They get paid first no matter what. After them, you have unsecured senior debt and then subordinated debt.
So all the creditors, they have to be made whole before any owners see dime.
Exactly. Once the creditors are paid, if there's anything left, you move to the equity holders. First up is preferred stock, which often has special liquidation rights. Then last in the equity line is common stock. That's your general ownership class.
And the big question, where are the tokens in that line?
They are at the absolute bottom, below every single debt holder, below every preferred shareholder, and yes, below every common stockholder. In legal terms, tokens are often defined as certificates of utility with zero claim on assets or revenue.
Wow. So we're talking about an instrument that's already seen as riskier than common stock, which is the riskiest traditional asset. And yet, the tokens are structured to be even lower than that, holding no formal claim at all.
That is the core realization, and that hierarchy dictates everything in an M&A process. Circle wasn't operating based on community feelings. They were acting on their fiduciary duty to their own shareholders.
Their lawyers probably told them the token was a huge liability.
Of course they did. Acquiring the AXL token or paying out token holders would have introduced massive unnecessary risks, regulatory risks, unpredictable governance obligations, legal claims, you name it.
So from Circle's point of view, the token wasn't an asset they wanted. It was a risk they had to actively avoid. They bought the people and the code and legally just discarded the rest.
Precisely. It was a rational business choice that maximized their gain, the CCTP tech, and the talent, while minimizing their potential legal headache, which was the AXL token community. And look, history's full of this stuff. When companies go bankrupt, some investor classes always lose out. That's how the hierarchy works.
But I have to push back a little here. I get the legal definition, but if tokens are fundamentally structured to be worthless in an exit, isn't this a massive red flag for the entire crypto venture model?
That's the billion-dollar question.
Why would anyone keep funding these token-first projects if the founder's exit plan can just cut the token holders out completely?
That is the right question, and it's why this case is so important. The realists, they argue that the value of Axelar wasn't in the token. It was in the future work of the team that created it. Avichal Garg from Electric Capital put it really bluntly. He said, "This is normal. If all future value is created by the team, no company will be willing to pay returns to investors.
So he's saying if the team is where all the future value comes from, an acquirer will only pay the team. There's no obligation to pay the people who funded that team's runway.
Exactly. It's like
Yeah.
you may have funded the movie, but you only own a collectible ticket. The ticket lets you in the door, but it gives you absolutely no claim on the film studio's profits when they sell the distribution rights. From a strict M&A perspective, the token holders were never investors in the proprietary IP that Circle actually wanted to buy.
Okay, so we've looked at the emotional argument from fairness and the counter-argument rooted in corporate law. And now we have to bring them together because both sides have, genuinely valid points. The anger is real because risk was taken. The structural analysis is real because tokens legally have no claim.
And that synthesis brings us right to the core issue this whole saga forces the industry to confront. What, legally and economically, is a token? The Axelar case just exposes the inherent hypocrisy, the structural vulnerability that the crypto industry has carefully built over the last decade.
And a lot of that building was done specifically to avoid regulators, wasn't it?
Absolutely. That is the essential context here. This structural flaw came from regulatory arbitrage. Founders wanted the massive upside of financing their projects with these global, publicly traded tokens, but they were also desperate to avoid having regulators, like the SEC, classify those tokens as securities.
Because to be a security, you have to pass the Howey test, an investment of money and a common enterprise with an expectation of profit from the efforts of others.
Right. And the main way projects avoided that definition was by writing legal documents that explicitly define the token as a utility, or a license, or a certificate that grants no formal rights to the project's ownership, profits, or assets. They were deliberately designed to sit at the bottom.
So the industry created this elaborate narrative where tokens felt like they were quasi-equity, a claim on future success. But institutionally and legally, they were built with the seeds of their own destruction. They were built with no rights whatsoever.
It's the ultimate structural mismatch. When the market is booming, everyone agrees the token represents shared ownership and upside. But the second a real-world event like an M&A or a bankruptcy happens, the corporate lawyers pull out the original fine print, and that illusion it shatters instantly.
And the tokens are immediately reduced to their original, legally defined status.
Certificates without rights.
So the token holders, they bet on the team, they funded the team, and when that team successfully exited, they discovered the fine print they all ignored was the only part that ever really mattered.
The value of the AXL token was tied to the commitment of that core dev team, that 15% price drop. That was the market instantly realizing that the narrative commitment had been bought and monetized by Circle, leaving behind nothing but a decentralized shell.
So the root cause of these conflicts, and we've seen this before, is this fundamental mismatch between the equity-like story and the underlying structural flaw of having zero formalized rights.
And the conclusion is pretty stark. Tokens do not inherently possess rights, only institutionalized and structured rights, rights that are legally recognized that can be enforced in a traditional court of law. Only those will be respected at these crucial moments. Until that changes, tokens will always be vulnerable to this kind of structural rug pull.
This deep dive into the Circle Axelar saga really gives us a textbook example of a capital structure conflict. You have a development team that successfully realizes their equity value. They leave the token holders behind. And in doing so, they expose this critical weakness of relying on unstructured narrative-based rights. It forces everyone in this ecosystem to look in the mirror and ask, does our funding mechanism actually represent what we claim it represents?
And that's the urgent takeaway from this whole controversy. This isn't just about one project. It is a systemic warning shot. The Axelar saga needs to be a call to action for everyone, founders, VCs, community members, to explore and actually practice specific ways to formally institutionalize token rights.
You mean defining them legally?
Yes. Defining a token's actual position within the traditional capital structure, not just in a white paper, but through legally enforceable means.
Because if the industry fails to do that, if tokens are just left to languish at the very bottom of the priority list, beneath all forms of debt and stock, how can real capital ever be reliably attracted to this ecosystem? You need certainty for massive growth.
And, maybe more simply, if you, the listener, are invested in a token right now and the team exits tomorrow, what specific legally enforceable claim do you have on that value? If the answer is none, I just have a narrative, then the industry is setting itself up for this to happen again and again, where business as usual is felt by the community as a rug pull. And that lack of certainty, it just undermines the foundational trust you need for any kind of long-term success.